Welcome to the part 3 of the Yahoo Finance video tutorial series. Let's pick up where we left off from last week, but this time I'm going to go over Meta platforms, or formerly known as Facebook, ticker symbol FB. So we left off at the ex-dividend date. The next one is 1-year target estimate. What this means is that Wall Street analysts are predicting what the stock price will be 1 year from now. Looking at this, analysts on average are predicting the price to reach $401.78 a year from now. Just keep in mind that price targets are almost never accurate. I never take their price targets seriously. Now that we're done with the summary, let's move on to statistics. Market cap shows the company's worth. So looking at the last few quarters, Meta Platforms was worth $746 billion in September 2020, and now it's worth $917 billion. It shows that the company is consistently growing quarter over quarter. Enterprise value is like the theoretical takeover price if a company gets bought by another company. This is where you add the market cap and their total debt, and then you subtract it by cash and cash equivalents. Let me give you an example. If Meta Platforms' market cap is at $900 billion, their total debt is $10 billion, and their cash and cash equivalents are $60 billion, then you add $900 billion with $10 billion in debt, and then you subtract $60 billion in cash. So the enterprise value is different from the market cap because it accounts for the company's cash reserve and their debt. Next one is the trailing PE of Meta Platforms. I talked about the forward PE in my previous video. The trailing PE is the price to earnings ratio based on the last 12 months of actual earnings. Forward PE, on the other hand, is the price to earnings ratio based on the forecasted earnings for the next 12 months. Let me simplify this by looking at the PE this way. If Meta's earnings are expected to grow, then the forward PE ratio would be lower than the trailing PE. So if you look at the current valuations, forward PE is lower than the trailing PE, so analysts are expecting Meta to grow on the upcoming year. On the other hand, if Meta's earnings are expected to decrease, then you will see the forward PE ratio to be higher than the trailing PE ratio. The PEG ratio is the enhanced PE ratio by adding expected earnings growth into calculation. So just keep in mind that the PEG ratio can be different depending on which EPS growth estimate you're using to calculate the PEG. So typically when the PEG ratio of a company is equal to 1.0, then the company's share price is at a fair value. If it's greater than 1.0, then it is considered overvalued. If it's less than 1.0, then it is generally considered undervalued. Let me give you an example. Let's say I'm projecting Facebook or Meta to grow 20% in EPS for the next 5 years, then I'll say the EPS will grow from 13.97 now to 16.76 in 2026. If the forward PE is about 22, and if I divide it by 20% EPS growth, then that'll give me 1.1 in PEG ratio. You can compare Meta's PEG ratio to other social media companies like Twitter, Snapchat, and Pinterest to figure out which stock is the right choice for you. So with that said, if you enjoyed this type of content so far, hit the subscribe button and I will go over more stock market terms next week. Don't forget to check out my previous videos as well as the new fire video coming out on Friday. Have a good one.